Hello everyone, it's Thursday and you're watching Within the Frame. I'm Kim Bo-kyung. This week is a major one for markets as central banks make rate decisions. The Federal Reserve started first, holding its key interest rate steady for the third time in a row. This comes as the inflation rate started to ease while the U.S. economy is still holding up. While indicating 3 possible cuts coming next year, it added it would take multiple factors into account for any more policy tightening. Meanwhile, the European Central Bank and the Bank of England will unveil their own rate decisions on Thursday local time, but they too are widely expected to freeze their key lending rates. How do experts see the Fed's decision, and are there any possibilities of deflation? Will the freezes affect the decisions of other central banks, including the Bank of Korea? For more on this, we have Professor Kim Se-won from Ewha Women's University. Welcome, Professor Kim.
Thank you for having me today.
And we also have Professor Greg Butchuk from Stanford University. Good to see you, Professor Butchuk.
Thanks for having me.
All right, Professor Kim, let's first take a look at some of the factors the Fed would have considered. Recently, the Bureau of Labor Statistics unveiled data saying the U.S. added 199,000 jobs in November, a jump from October. Also, the unemployment rate fell to 3.7% from the previous 3.9%. How did the market see the figure?
U.S. labor market continues to provide positive signal in terms of payroll and unemployment rate despite signs of weakening economy. Particularly, the payroll grew even faster than expected, along with lower unemployment rate than expected. Federal Reserve officials are watching the job market numbers closely as they continue to try to bring down inflation that had been running at a 4-decade high, but recently has shown signs of easing. As of now, U.S. labor markets situation provides more room for Federal Reserve to control inflation through adjusting the base interest rate. But we also see different signals from U.S. labor market with continuous rising in jobless claims, which indicates that labor market is cooling. In this respect, we can say that U.S. labor market signals are kind of mixed between positive and negative.
All right, so it is sending a mixed signal. I see. Now, Professor Butchuk, inflation, of course, is another major index we need to see. The U.S. Consumer Price Index was released just the day before the FOMC meeting, showing CPI slowed to a 5-month low in November. This could have been one of the major reasons why the Fed was able to hold interest rates steady, right?
That's right. So headline CPI rose 3.1% year over year in November. That's lower than its peak last year of almost 9%, and it's come down a lot in the first half of this year. It's been hovering around that 3-4% mark since June. Core CPI, which is it's a similar number that excludes some more volatile items like food and energy, it's still a little bit higher, but it's been following the same general pattern of it used to be high and it's come down a lot. They're both on their way down, but both numbers are still a bit higher than the Fed's long-term target of 2%. So, what is the Fed targeting? There's 2 things: low inflation and low unemployment. The Fed sort of implicitly has in mind a model where there's a trade-off between inflation and unemployment. The kind of view is that if we increase interest rates, that will bring down inflation, but it risks increasing unemployment and vice versa. And just sort of thinking where we are in terms of the Fed's objectives, as Professor Kim said, the unemployment rate in the U.S. is near historic lows. The labor market is looking pretty strong. There's a few signs of weaknesses, but overall things look good. The inflation rate is coming down, but it's still quite a bit above target. And because the direction looks good, maybe there's not a strong motivation to raise rates, but since the level is still a bit higher than the Fed would like, sort of the textbook response there is to keep rates elevated, at least while there's still some slack in terms of employment. And that's exactly what the Fed did.
All right, I see. So we could definitely say that the inflation is being tamed, but like you said before, it is still higher than Fed's target rate. All right. Professor Kim, considering all these figures, the Fed decided to freeze the rate. And on Thursday local time, we'll be able to see retail sales figures. As far as I know, U.S. retail sales fell for the first time in 7 months in October. If there is a fall for the second consecutive month, could it mean that the U.S. economy is slowly being hit by the lengthy high interest rates?
As we talked about, all figures are not pointing that U.S. economy is okay. There are lots of evidences that U.S. economy is cooling down. And one of the main reasons that U.S. Fed freezes its key rate this time is while inflation is not fully stabilized, U.S. economy is kind of slowing down. Related to that, retail sales is one of the most important variables that represents the whole domestic consumption, which covers more than 60% of U.S. GDP. Last month, consumers cut their spending at stores, tapping the brake on economic growth ahead of holiday shopping season. U.S. retail sales fell 0.1% in October from a month earlier. And that is the first decline since March and comes after 0.9% increase in September and robust gains earlier in summer. These retail figures, combined with slower hiring and easing inflation, indicate that the economy is cooling after a surprisingly strong growth much of this year. It also means that if we see another drop in retail sales in November, Fed is more likely to cut its key interest rate earlier than expected to recover the economy.
All right, I see your point, Professor Kim. Professor Butchak, one more before we talk about the rate cut. The housing market remains plagued as well, causing sales to drop to historically low levels. According to the National Association of Realtors, the pending home sales index dropped to 71.4 in October, and this is its lowest level since 2001. What does this hint at?
Great. So this index that you're referencing, it's about the quantity of sales, and it's saying that the quantity of sales is low. Let me give you a few other useful stats to kind of put this in context. House prices are still near all-time highs. And there's also this fact that when a house goes on the market, the median time it takes to sell is now only 15 to 20 days, which sort of in the bigger scheme of things is very fast. So this points to there being actually a low supply of housing on the market. In other words, people would like to buy houses. It's just that nobody really wants to sell. So what's kind of happening there? I actually teach a class about these housing issues, and I could sort of go on forever. Let me highlight two things that I think are really important. So one is there's kind of a long-term structural issue in the US in that there's just not enough housing in places where people want to live. So there's a lot of reasons for this, things like zoning laws, construction costs, and so on. But kind of more relevant to our discussion and kind of where we are in the business cycle, and this is a bit of a US specific thing, people who bought their house in the past 5 or 10 years, they locked in a very low interest rate on their mortgage. So most mortgages in the US, they're very long-term, they're fixed rate. And what that means is if you borrowed at 3%, you still pay 3%, even if prevailing rates increase a lot, as they have. But the catch with this is that if you do move, you have to take out a new mortgage at the higher interest rate. And what this means is there's a lot of people who are kind of locked into these really great low rates. And if they wanted to move, they would have to give that up. And that kind of keeps them in their current house, and it keeps them from putting that housing inventory on the market. It's kind of this perverse unintended consequence of Fed monetary policy. They want to push prices down, but for this particular asset, there's this opposing force that makes it a little more difficult. Now, eventually rates are going to come down. People will need to move. We're making some progress on new construction. Volumes will pick up and prices will return to more reasonable levels, but at least in the short term, the housing market is really locked up, and it's really about a lack of supply.
All right, I see. Well, thank you for your kind explanation, Professor Butchak. Now, Professor Kim, though the Fed chair said no one is declaring victory just yet, he admitted that officials are discussing rate cuts. When it will be appropriate is up for discussion. What are the scenarios and what would be the criteria for rate cuts in Fed's opinion?
Well, that is a tough question. I wish I know the answer, but there's no question, of course, that zero interest rate has been the strongest momentum in booming the equity market all over the world. But the fact is that the timing of Fed interest rate cut is decided by the path of future inflation, employment, and growth rate, and so on. It is true that the possibility of interest rate cut is higher than before, but it should be also noted that equity market investors' hopes are too much incorporated in interest rate cut possibility. For example, if U.S. inflation goes up about 4% on year next month, the interest rate cut expectations will be wiped out right away. But as of today's data and expectations, it is more and more likely that U.S. Fed would cut its key rate between first and second quarter of next year.
All right, I see your point. Now, Professor Butchak, because of markets' expectation that Fed will cut rate, there was a recent swell for gold and crypto. And now that the Fed did indicate rate cut to come, will the surge continue?
So I have to admit, I'm a little bit of a crypto skeptic. So let me do my best, kind of starting with fundamentals. So gold and crypto are they're both actually useful, and they derive some value from being useful. Gold is easy. It's used in electronics, it's used in jewelry, and so on. And the fact that it's useful, it makes it valuable beyond people just thinking it's valuable. For crypto, there's a ton of hype, a lot of very scammy nonsense around it, but it does have a kind of real, little bit boring use, which is it's useful for doing transactions that the normal financial system doesn't really want to touch. So that's partly a euphemism for doing illegal things like buying drugs or money laundering, but also things like cross-border transactions to and from countries where this kind of transaction would be slow or there are capital controls. So, whatever the legal status of a given transaction is, some people want to do it. Crypto is useful in doing it, and that kind of gives crypto its value. Beyond that, gold has always been this kind of favorite among people who have a little bit of skepticism around the mainstream financial system. Crypto kind of has that same sociology around it. It's all this DeFi stuff you hear. There are a lot of people who are just kind of true believers in this decentralized dollar-free financial system, and they love crypto. That drives a lot of speculation away from the fundamentals that I highlighted, and these people are sort of always very interested in what the Fed's doing. I think there's also a view, it's relevant to our conversation, that gold and crypto are very good inflation hedges. It turns out that's not really supported in the data. It kind of looks like it might actually go the other way for Bitcoin. And as you mentioned, it sort of reacts the opposite way to rate cuts that a good inflation hedge would be. So I don't think these price moves are an inflation hedge story. If anything, it's kind of the opposite. What I would say is probably the main driver of a lot of recent Bitcoin price movement is just speculation about future regulation. So regulators worldwide have been very unfriendly towards crypto, correctly, I think. But there's some hope from these investors that regulators may ease off, for example, by letting ETFs buy Bitcoin. And that, of course, would be very good for the price.
All right, I see your point, Professor Butchak. Now, Professor Kim, turning our attention to other countries, Moody's downgraded its outlook on China's credit rating to negative from stable. What was the reason behind this?
I think China's current economic problem is not a cyclical one. China faces, I think, structural economic problems now, which is not avoidable. One of the largest reasons for China's sovereign rating downgrading is related to China's real estate market collapse. The importance of China's real estate market is different from those of Korea and the United States. China's real estate market covers more than 30% of total GDP, while Korean real estate market covers less than 10% of GDP. Two largest Chinese real estate developers, Hongdae and Biguiwian, are at the edge of bankruptcy, and it looks that Beijing does not have a clear solution about these bankruptcies. Also, Moody's, the credit rater, said the growing debt problems of some cities and provinces would face China's central government to provide financial support when economic growth is slowing. it would further worsen China's economic growth for the next 2 to 3 years.
All right, I see. So the downgrade was mainly due to China's structural economic problems, especially those related to real estate. All right, I see. Now, Professor Butchuk, one more regarding China's economy. China's CPI dropped 0.5% in November on an annual basis, the biggest fall since the pandemic 3 years ago. And experts say this shows China is falling deeper into deflation territory and that there needs to be urgent action from Beijing to boost the demand. How do you see this? And if deflation does hit China fully, what impact would that have on the global economy?
Yeah, so it's kind of funny. We were talking about the problems with inflation, and now here's deflation, and we also think that's bad. So let's take a step back and think about what might be bad about deflation. What's wrong if things get cheaper? So it can be a mixed signal. Some of this might be supply driven. So for example, I think pork production in China has been super high. That's caused lower pork prices, and ultimately that's kind of a good thing for consumers. But on the other hand, it could be a sign of weakness on the demand side. And there are a bunch of troubling trends. I think Professor Kim highlighted the property sector in China is sort of could be a driver behind consumers stepping back in terms of reduced demand. So, the governments can become very concerned about long-term deflation. It can be something that's very hard to get out of. The typical monetary policy answer is to lower rates, and China has some room to do that. I think the concern there is that this might kind of reignite some of the malinvestment in the property sector that Professor Kim referenced, and this is not something that the government really wants to encourage. The fiscal policy answer is, of course, government spending, but the question for China is whether the government can really target it towards consumers rather than towards additional infrastructure and housing spending. Historically, this kind of infrastructure or housing construction has been really great for China, and it's been really important for their growth. But at this point, they've sort of built so much housing and they've done so much infrastructure construction that additional construction there may not be super productive. It's kind of like paying people to dig holes. So the government could find itself in sort of a difficult position to do effective fiscal policy, also considering the sort of local government debt issue that Professor Kim brought up. Now, for the global economy, right now, China's deflation is probably a little bit helping everybody else in terms of tackling inflation. Energy prices have come down, input prices have come down a bit. But if that deflation does lead to a kind of full-on economic contraction in China, this could be pretty bad for the global economy, especially for countries like Korea that export a lot to China.
All right. Well, thank you for the explanation on deflation. Well, Professor Kim, like I said in the opening, the Fed's decision will be followed by the European Central Bank and the Bank of England's. They're all broadly expected to hold interest rates steady, right? What is your forecast?
Well, actually, the largest victim of global inflation in the last 2 years were European countries. Temporarily, UK's inflation last year exceeded 10% on year. But Eurozone's inflation is pretty much stabilized with like only 2% level, like 2.4% in November, which reflects its lowest level in more than 2 years. So European Central Bank and Bank of England would implement more orchestrated interest rate policy with United States Fed's interest rate policy next year. Also, some Eurozone countries are under a very difficult situation in terms of economic growth, particularly in Germany and Italy. So it is necessary for these countries to cut the rate for recovering economy next year. The market is closely monitoring European Central Bank's meeting for any sign of central bank is posed to impose swift rate cuts in 2024. So I would say in the end, the European Central Banks and the Bank of England will freeze its interest rate until U.S. Fed decided to cut the rate.
All right, I see your point, Professor Kim. Now, we are running out of time, but I'd like to ask this last question to Professor Kim again, because it's on the Bank of Korea. The Bank of Korea held its key rate for the 7th consecutive time. Given revised economic growth for next year, if the U.S. starts rate cuts next year, would South Korea follow suit or not?
Well, actually, Bank of Korea began to raise its base rate well before U.S. Fed did in 2021. But Bank of Korea's speed of interest rate hike was slower than that of the U.S. Fed. As of now, the base rate difference between the two central banks is 2% exactly, which is one of the largest in history. And along with much stabilized inflation in Korea at only 3% on year, Korean economy's performance is weakened this year and expected to be more weakened next year. This year's growth is expected to only 1%, and next year's growth is expected to slightly higher at only 2%. So the position of Bank of Korea in interest rate decision is almost the same as European Central Bank. It is highly expected that Bank of Korea would begin to cut its key rate after seeing U.S. Fed interest rate cut sometime next year.
All right, so it's positioned similar to European central banks. All right, well, unfortunately, this is all the time we have for today's edition. Thank you, Professor Kim and Professor Bichuk, for your time and insights. We really appreciate it.
Thank you very much.
Thanks for having me.
All right, that's all for Within the Frame tonight. We'll be back tomorrow with more in-depth stories. Thank you for watching, and goodbye.